Okay, perfect. So, as Peyton mentioned, I'm Adriana Adams. I am a certified financial planner, which is essentially the gold standard for financial planners. And there's rigorous training and coursework. And actually, my degree is in financial planning from college. So, well trained in investments, tax planning, retirement, college, insurance, estate planning, just ethics and but today we're going to focus on spending habits, budgeting, and kind of beginning investing. And I have been doing this for about 10 years now. I have a pretty wide variety of a background. I started at a small firm in Cleveland, Ohio. I'm still in Cleveland today. And kind of that's where I grew up or learned the ropes of the industry. I spent some time at Morgan Stanley as well, just kind of the opposite, big corporate Wall Street. And I now work at a fintech or a financial tech company called Domain Money. I'm the head of financial planning there. So I've got kind of a unique set of experience in how I've seen the industry. My expertise and the areas I really like to focus on are budgeting, investments, and financial wellness, and just financial education and literacy. I think it's just super important and sets a great foundation for your future. I'm also known on the internet as Advice with Adrianna. I'll give you my contact information at the end. There's an Instagram page where I try to post content that can be helpful to you. I'll also give you my email address. So if anyone does have follow-up questions, I'd be happy to field those later as well, or you know how to get in contact with me. Anyways, let's get right to it. So the brief agenda, I already covered a little bit, but I'm just going to touch on financial planning and what it is, as well as the spending plan and the investing. One of my kind of rules of thumb that I try to avoid the word budgeting. I feel like it just has a very negative connotation. So if you see me say spending plan, that really just means budget. But I feel like it's just a better word and a little bit more positive. And one of the other things that I'm going to try to do today is give you guys a lot of really practical advice that you can try to implement. So hopefully you'll be able to take away a few things that you can get started on today on your own and build into kind of your routine and just your financial health moving forward. The first thing I want to touch on when it comes to financial planning is that time is finite. So putting off financial decisions can cost you money. Making choices that don't align with your goals can also cost you money. I like to give a real world example here just to put some context to it. I'm sure you guys can think of examples that have impacted your life on your own. But one good example is I had a client last year actually who had a lot of company stock for she worked for a fintech bank, and a lot of her compensation was paid in stock rather than normal salary. She wasn't really sure what to do with it, and so before she came to me for help, she still had the vast majority of her savings in this stock. Unfortunately, by the time she came to me, the stock had completely gone under. And so she lost a large chunk of her money. And so she obviously didn't expect that to happen, but it's just a good point that I like to make to say, the sooner you address things or have questions, the better, because we don't know what the future is going to hold. And so she knew she needed to address it, and she was just a little bit too late, and it cost her a lot of money in the end. Another kind of example that might be relative to like your 401k, like having the wrong investment allocation. So just slight tweaks of how much is in one fund or the other it can affect thousands of dollars in the long run, year over year. So those are little things that just kind of making sure you understand the different pieces of your finances so that they can help you in the long run and make sure that you end up in the best situation. The first thing I want to start on is net worth. And this is very basic financial planning 101, but I cannot emphasize enough how important it is to know what your starting point is. So if there is one takeaway that you guys have from today, it's to create a balance sheet for yourself so you have a benchmark. So that way next year you can look on it and track your progress. It's very difficult to go back and pull statements and things from the year before to figure out where you really were. So if you don't take the time today or in January or next month, whenever it is, to get this on paper and documented somewhere for yourself, it'll be really hard to tell if you actually achieved your goals or had a good year or not. So in the simplest form, net worth is just your assets, which is things that you own, minus your liabilities, which is things that you owe money to, and that gives you your net worth. Everyone's situation is going to be different, but my rule of thumb is to try to grow this 5 to 10% each year. So that'll be a combination of potentially growth of the investments if you're invested, or your contributions that you're setting aside and adding to your assets or your savings. Any questions there before I keep going? Just want to make sure I'm mindful of everyone. I don't know if I can see the chat actually, Peyton. So if you do have any questions, feel free to chime back in, Peyton, and I can address them.
Perfect. I'll let you know if any come through.
Okay, thanks. So high level, there's different types of assets, and I like to talk about them in terms of what's most liquid to what's the least liquid. So liquid assets is going to be anything that's like in your checking account, savings accounts, CDs, or money markets, things that you can pretty much access at almost any time if you needed to. The next step up from that is what we call taxable assets. And that's going to be like your normal investment accounts, or maybe it's cryptocurrency or something that is not in a retirement account that's tied up. That leads me into the third category, which is retirement assets. And this would be like your 401k, or if you have an IRA. These type of an account come with restrictions that you have to wait to a certain point or a certain age to access them without penalty. So they're definitely less liquid than the traditional taxable asset. And then the last thing on the list is personal assets. So this is just tangible stuff like your house, your cars, things that you own. Obviously, those are just illiquid in nature because you would have to sell them to be able to use the asset. And then when it comes to liabilities, this can be kind of a wider range. I don't have really a framework for lumping them into categories as much, but I do have one kind of pro tip here of like what is a good liability and what's a bad liability. A lot of times people get nervous about taking on debt. Um, we could spend a whole nother session on good debt versus bad debt, but just a framework for you of what to consider good debt or bad debt is kind of looking at the interest rate that you're paying on it. So things that are bad debt, I would say anything with an interest rate north of like 7 or 8%, because that's going to really build over time and cost you a lot of money. So credit cards tend to have interest rates north of like 20%. So we want to pay those off before you incur any interest. Whereas good debt is anything that's below like 6 or 7% interest rates. And carrying like a mortgage or even some student loans, right? Things that are benefiting you towards your future that have an interest rate that's manageable or what I would consider good debt. So we don't necessarily need to pay off all debt as fast as possible. It's not bad to have debt on your balance sheet, but we just want to be mindful of what is good and what is going to hurt us in the long run. So how to build a balance sheet. If you haven't done this exercise before, I have an example here, just kind of very basic how you would build it out in Excel. You can do it on paper in your notebook, but like I said, just get it documented somewhere for yourself. So you just start with the liquid assets at the top and list out your bank accounts, and then move down the list through all those categories we talked about and just list out everything you have. Maybe you have, a vacation house or another car or a boat or something. So you can be flexible in what you add here. And then below that, list out your liabilities, and then you can very easily just subtract all of your debts from your assets and figure out what your starting point is. And this will give you a good framework for moving forward. And tracking your balance sheet, I should mention too, this is an annual exercise. A lot of things that touch your finances, we want to look at them more frequently than once a year. But it can be really cumbersome to update this, and with small changes in the market or the value of your home is probably not going to change day to day. So this is something that I typically suggest doing once a year, or, maybe once every 6 months if you want to kind of mid-year check-in, but it's not something you need to spend time redoing every single month because it's kind of a slow roll. It's not going to change a lot from day to day. And then moving on from that to kind of taking it a step further, is assigning goals to everything. So I always say that in order to optimize our balance sheet, everything on your balance sheet needs a purpose. If it doesn't have a purpose, then let's figure out a way to give it a purpose, or maybe put it into something that has more of a purpose towards your goals. So I always suggest having kind of these goals written out as well with your balance sheet. So again, you can track your progress over time as to how you're reaching them. But one thing that's really important is that every goal needs both a price tag and a time horizon so that we can figure out what kind of savings mechanisms we're going to use to reach that goal. And really the driving factor here is the time horizon. Because if we have a goal that we're going to try to strive for in the next 2 to 3 years, we're going to want to use something really liquid towards the top of our balance sheet. You don't want to be super invested and aggressive if you need the money short term, just because there's volatility when it comes to investing and things might go down before you need that money. Now, if we have something that we're looking at that's maybe 5, 10 years away, that's when we can start going down the balance sheet and looking at other types of assets to assign a purpose to that goal for. And then a very quick way of trying to figure out like how long it's going to take you to hit that goal would just, I'll give an example of one that's kind of on this balance sheet is if you need a new car by 2026, we've basically got, let's say we'll use the end of 2026 there. So you have a goal of having $40,000. Oh, I think, can you still see my screen?
We can see your desktop now.
Okay, hold on 1 second.
Mhm.
I don't know how to get it back.
Maybe stop share and then reshare that screen.
Okay, one moment. Sorry for the technical difficulties, guys.
I feel like it's got to happen once in every presentation.
It does. It does. Okay, here we
Use the
go.
Windows key and the Tab key.
Perfect. Got it. Okay, we should be back in business now. Let me try and reshare. Okay, there we go.
Perfect.
So back to that example of saving for a new car. So if you've got $40,000 of the goal, and that's kind of the price tag of the car you're looking at, we've already got, you can see an extra $5,000 kind of allocated towards that new car goal. So we need to save another $35,000 over the next 2 years. So you just divide 35,000 divided by 24 months and figure out how much to set aside every month so that you can hit that goal on time. And this gets a little more complicated the longer we look, but that's just an easy way of trying to figure out kind of how long it might take you to reach one of those goals. And then one pro tip here that I would say, just coming from a financial planning standpoint, is I always suggest focusing on what I call the bookend goals. And that's your emergency fund, which is your short-term liquidity, and your long-term goal of most often it's retirement, right? Making sure that those two goals are taken care of before we start filling in additional goals in the middle. It goes back to that saying I mentioned in the beginning of time is finite. So we want to make sure that we understand what you need for retirement and start chipping away at that goal today or those long-term goals. And then we can see what's kind of left in your balance sheet or in your budget to save towards extras. Okay. And now when it comes to setting goals, I have kind of some frameworks for what I consider short-term, long-term, midterm. And so the first thing that I want to touch on is everything above the line on this slide is something I would recommend keeping your savings in cash or like a high yield savings account. So it goes back to that anything within the next 3 years that you need, it's potentially too risky to try and invest towards those goals because the market is really volatile. If we look at this might get a little technical, but it's a fun fact of mine. So if you look at the rolling stock market performance over the last or over 2 years at a time, just over the last like 40 years, it's pretty volatile from a 2 year standpoint. But if you look at a rolling 3 year time period, the market is almost always up. So that's how we back into this kind of rule of thumb of saying if you need money within the next 3 years, let's be more conservative and use a high yield savings account or something that'll earn you a little interest, but that is going to at least maintain what you've got. And then if we have longer term goals, we can start looking at investing in different ways because we've got time on our side and that volatility will play out and you will likely be better off in the long run. So sinking funds is a topic that I'm also really passionate about. And this is looking at everything that you plan to spend throughout the course of a year that's not something that's going to come up monthly. So a lot of times I find clients that struggle to come up with the cash when it's time to pay maybe their annual insurance premium or their property taxes, right? Things that you don't necessarily pay every month because it's not built into your monthly budget necessarily. So one way of looking at this is saying, okay, I know my car insurance comes out every December. It's $2,000. So $2,000 divided by 12 months, I'm going to set aside that amount every month right from my paycheck into my savings account. That way, at the end of the year, when the premiums due, you've got the cash there already and you can pay it and it doesn't eat into your budget for that month or put you into a short-term deficit. So this can be used for a lot of different concepts like I've laid out here, like maybe your annual travel goals, or if you have regular car maintenance or property taxes, insurance, anything like that. And then anything else, like I said, in the next 0 to 3 years, we want to keep that in cash. And then midterm goals, this is where we can talk about starting to invest the funds, but you might still want to be a little conservative and have a specific way you're going about investing. And then long-term goals, anything over the next 10 years or more, that's when we can get more aggressive. Um, and so then as far as I mentioned a lot about high yield savings accounts, I just want to give you a couple examples of kind of ones that I tend to like and that my clients tend to like. Ally Bank has a great offering. Marcus by Goldman Sachs, Capital One, American Express has a good one. But really, I usually recommend starting with wherever you bank or where you have credit cards. And if they have an option, they're usually pretty competitive. So keeping, less institutions typically tends to be easier to manage from your own standpoint. So I would start there, but if you do need a place to look, check out some of those names that I just mentioned. So moving on from the balance sheet, I want to get into kind of the spending plan and budgeting and looking at what's coming in and out. Now, I know I mentioned the first thing was if you do one thing, it's going to be to build your balance sheet. If you're going to do two things from what we talk about today, the second one is creating a plan to understand your cash flow. This is like the key to actually achieving your goals is knowing what money is coming in and what money is going out. And then we can start addressing how to reach our goals. So a few rules of thumb when it comes to budgeting. These are kind of the ones that I find to be most tried and true across any type of um, income level. So I try to keep them kind of broad based because I know we've probably got a wide variety of people listening today. So from a housing perspective, generally speaking, you want to keep all of your housing costs less than about 32% of your pay. This would include like your rent or your mortgage, your utilities, your taxes, your insurance. Um, and kind of this is one of my unique like pro tips, if you will, is to focus on your take home pay. If you Google this, a lot of times you will come up with answers that say like 32% of your gross income. However, just in my 10 years of doing this, I find that that tends to create a lot of financial friction, and 32% of your gross pay ends up being 40 or 50% of your take home pay. And then it really starts to feel a little bit tighter. So if you focus on 32% of your net pay, you will feel like you have more flexibility for more fun things and savings goals. And it tends to lead to just better financial wellness in general. The same goes for auto expenses. So I typically recommend keeping this below about 10% of your take home pay. Same rule of thumb. If you Google it, you'll probably find a lot of people talking about gross, but healthy financial habit to try and make sure that you have good habits is keeping it a little less so you've got more flexibility to work with your income. And then one other one that I find most often is almost any good budget has a 50-50 split between restaurants and takeouts and groceries. And so if you find yourself kind of struggling when you're looking at your budget, this is an area to take a look at. If you see restaurants are really high, groceries tend to be really low. Groceries tend to be cheaper than going out to eat all the time. So this is just one of those that I find to be kind of tried and true that I see across the board, that usually a pretty healthy budget here is a 50-50 split. Um, and I've got a ton of other benchmarks for different types of situations, regional, different income levels. But again, trying to keep this high level for you guys. But if you have questions or need help from that perspective, let me know and I can share more insight there. A couple of common strategies when it comes to budgeting. There's the 50-30-20 rule, which is one of the most common ones on the internet. This basically just says about 50% of your income goes towards your needs. So again, house, car, things like that. 30% goes towards your wants, 20% goes towards savings and debt. Another more kind of loose version of this is the 80-20 rule. It's the same thing. It just says that 80% goes towards needs, wants, whatever, however you make it work. It doesn't have to be that 50-30. And then 20% towards savings or paying down debt as well. Now, one of the things that I really like to help clients with is intuitive budgeting. And rather than trying to put yourself into a box of these percentages, is starting by looking at what you've spent in the past and then figuring out what drives the most value for you. So an example I have is one of my clients, they wanted to spend a lot of money on a big trip for their 40th birthday. We looked at their last budget and tried to figure out how to fit it in. And I always have them fill out a questionnaire first about what their values are before we get into it, so that I can really kind of play psychologist and look at where they're telling me they want to focus on. But then the spending can tell me a different story, and I can help you figure out how to really make sure that every dollar you spend provides the most value. So rather than spending a bunch of money on shopping or clothes, we were able to reallocate that to travel and say we're going to reduce this category for the year. So this is something that you can do on your own as well. And actually, I think I've got some resources on the next slide. So let me pivot there. Um, Yes. So tools that you can do to figure out where you're spending if you want to do this intuitive budgeting aspect. There are some kind of paid tools like Monarch Money, which is one of my personal favorites. I use it as well. It's an app. They have a website. You link up all your cards and they kind of tell you where your money is going, but you can tweak it and set goals and just get a really good snapshot of where your money is going. I think they charge about, I believe it's like $90 a year, or you can, if you pay for the full year, you get a discount. So not crazy expensive, but definitely costs money. Copilot's very similar, but it's another industry favorite. However, if you're looking for a free version of this, a lot of credit cards and bank accounts now do have a spending summary on their portal for you. So if you want to go the DIY route, start with your bank and your credit card and see if they give you some of this information, and you can just build it out in an Excel spreadsheet yourself, or even, pen and paper. You don't have to pay money to do a budget. A few other things that I like to suggest too, aside from just building the budget, is if you're looking for ways to save more money or accelerate your goals, I have a couple of things that I always try to kind of kick off in the new year or to help people who need help in this particular area. One of them is a no spending challenge where you rotate a different category every month. So one month it might be no eating out. The next month it might be no clothes. The next month it might be, no entertainment. We're doing movie nights at home every night. Whatever it might be, you can kind of rotate through so it doesn't feel too restrictive because it's not across the board every category. The second version of this is that you just do no discretionary spending every other month. So you kind of give yourself a break and you try to be strict for a few weeks and then you kind of get a little bit of a break again. Now, my recent favorite that I find in my personal finances and with clients that builds actually the best, most sustainable habits is doing quarterly low buy lists or setting up some sort of quarterly goal for yourself. So I'll give you a couple examples of what's on mine for this year. When it comes to buying anything from like Sephora or makeup products. I don't buy one until my last one ran out. So we're not buying a bunch of different things and testing everything out. You're kind of being practical about, okay, I already have that one at home. I don't need a new one right now. Um, Another example is that I do weekly Amazon orders now instead. So a lot of us get our household stuff from Amazon, things like that. But instead of just hitting the order button every time something pops up that you think you need, add it to your cart and then review it once a week. And this usually helps weed out some of the things that you might not need, or that you're able to get elsewhere for maybe a little bit cheaper. Okay. Pivoting to investing, which is arguably the most fun part of the conversation. I want to get into one, why it's important. And this is probably something that you have all felt over the last couple of years. It's important because we need your money to beat inflation. So over the last few years, you can see the prices of everything went up, right? Especially at the grocery store, things like that, the price of housing. So in order to reach your long-term goals, we need to make sure that your money's working for you and building wealth. I'll give you an example that's more long-term is in 1980, if you had if you had $400 in 1980, it would only buy you about $100 worth of stuff today. So that's only a fourth of the purchasing power. So that's why this is really important to make sure that we're not just saving money in cash, but that your money's actually growing. There's several types of investments. We've got cash, stocks, bonds, alternative investments. One of the things that I really want to focus on is investment vehicles. Can certainly get into more of the basics if that's helpful, but a lot of things that you might see like in your 401k or in if you're trying to invest is you'll see one individual stocks where you can just buy a company, right? You can buy Amazon, you can buy Google. And then there are kind of packages of stocks called ETFs, and this stands for Exchange Traded Fund. ETFs are great because they tend to track one piece of the market. So you can buy the total stock market ETF, and you can basically put $100 in and you can get a little share of every company in the stock market. So you get broad diversification and you don't need hundreds of thousands or millions of dollars to do so. Whereas like one share of a stock could be $500 on its own. So ETFs are a great way to get that diversification and invest in lots of things. Mutual funds are very similar, but they have a lot of different flavors. They tend to be more expensive and they're less tax efficient. I could go into this for hours as well. So if you guys have follow-up questions on that one, let me know. But I try to steer towards ETFs because they tend to be more tax efficient for you, especially if it's in like a non-retirement account. Index funds are basically a crossover of ETFs and mutual funds. And I throw this in here because I get that question a lot. So index funds basically They do track the stock market or track different things too, but they operate more like mutual funds. So again, they're a little bit less tax efficient for you. Now, questions on where to invest. So there's a lot of different platforms out there these days, and I have some tried and true ones that are more of kind of DIY. If you are comfortable doing it yourself and picking the investments, and this doesn't mean you have to be stock picking, right? But picking the funds and things like that. Fidelity, Charles Schwab, and Vanguard are all great options. They're tried and true. We've also got some robo advisors these days that are becoming more popular, and some of the better ones are at Charles Schwab, Wealthfront, Betterment. Again, I can do another whole session on this, but I have a couple of other tips and tricks I want to throw in, and I know we're running low on time. So, a few rules of thumb when it comes to investing is to keep no more than 5 to 10% in one stock. So, if you are interested in the stock market and you want to buy a couple of shares of Amazon or Alphabet, that's totally fine, but keep the majority of your money diversified across a lot of companies and just keep a little bit kind of in individual stocks. Having a combination of pre-tax, Roth, and taxable assets is going to be super critical, especially once you get to retirement and you've got kind of a mix of choices to help with your taxes. Another piece of advice, avoid timing the market. Again, I could go into that a ton. I'm going to fast forward quickly through my last two slides just to make sure I've got time to get through everything. A few things about your own 401k plan at Duncan. It's through John Hancock, and you get an employer match of 50% up to the first 6%, I believe. So that essentially means they'll match 3% of what you put into it. If you are not contributing at least 6% to your 401k, you're leaving money on the table. So I would highly encourage you all to take a look and make sure you're doing that so you're getting the full match. And then you've got a lot of investment options in there, like I was kind of hitting on earlier. Again, if that's helpful, I'd love to come back and kind of walk through that in a little bit more detail. But one last thing that I want to throw at you is another practical thing that can maybe help on your financial wellness journey. A few of my current favorite podcasts, Morning Brew Daily, they put in an episode out every single morning, and they give you basically the insight of what happened yesterday, what's happening this week. They put it in layman's terms. It's really easy to understand. So it's great to kind of start understanding some of those things and what's going on in the world. One of my favorite books as of late, The Paradox of Choice, Why More is Less. So, why having all of these choices in the world today can make things more confusing and lead to less satisfaction. Really interesting read. And then my favorite habit is to have a wants list in my notes app on my phone. So, it's like what I was saying on the Amazon cart, like build your cart and give it a week and look back and make sure you still need everything. You can do the same thing, not just with Amazon, but with any store or anything you see online that's tempting to buy. Put together a list, and then at the end of the month, if you've got extra money, kind of pick your top favorites off of the list rather than just frivolously spending throughout the time. Okay, we're right on the dot. I believe Peyton can send out the slide deck to you guys too, but here's some ways to reach me. I do have a couple minutes. If anybody does want to ask any questions, I'm happy to hang on and stay. But I really appreciate you all taking the time to come and join me today and learn about personal finance and some tips and tricks. And I wish you all the best on your financial wellness journey this year.
Thank you so much. I already have so many messages coming through talking about how helpful you were. We do have a
Awesome.
couple questions from the chat. So
Okay.
the first one that I see is, do you recommend adding insurance and property taxes into your mortgage, or is it better to pay them yourself, setting aside money like you said? Is there any advantage to that? Is it worth the hassle?
That's a great question. So, in theory, that will work out just the same as if you were to pay it annually and set this money aside yourself, because when you put the money into escrow, they basically do that for you. So I personally have mine in escrow, and I think it's really helpful. It takes that need from needing to do it yourself out. Um, the one hassle that I'll caution is sometimes if they overestimate or underestimate how much you're supposed to put in, you may owe a little bit more at the end of the year, or they may actually send you a little bit of a refund and say you've put a little too much in. But I do think it helps simplify and automate things. So I would definitely do that if you have the option.
Awesome. Next question I see is, when you talk about high yield savings accounts, what's the target interest rate? Oftentimes it's not very high or hard to find one that will keep up with the current annual loss of purchasing power.
Yeah. So this is a tough one because these interest rates do move with the general interest rate market. So when you hear in the news that the Fed is raising rates or cutting rates, that's going to affect what you're earning in that high yield savings account, unfortunately. But the goal is that for it to keep up with inflation. So over time, yes, maybe 2 years ago you didn't get 8% and inflation was really high, but generally speaking, you should try to get like 3 or 4%. However, just know that these are going to fluctuate over time. Right now, I would target north of 3%. You can probably find something in the threes or even the low fours or mid fours. One thing I would suggest though is not rate chasing because you'll see like month over month one day Wealthfront has the highest rate, the next month Ally has the highest rate, and they all kind of adjust lock and step. So pick one that is going to be easy for you to manage in your plan. And don't worry about, a couple basis points here or there, but make sure that you are earning at least like 3% to 4% today is a good target.
Awesome. Okay. Next one I see is should you refinance all loans higher than 9%? For example, credit card loans, should they be consolidated under a lower interest rate consolidation debt program?
Yes, great question. So, it definitely depends on the type of loan. I'll kind of target it to credit cards. One thing, if you have a credit card that has a balance that you're struggling to pay off every month, something I typically suggest looking at, assuming that your credit is in an okay place, is looking at 0% promotional credit cards. So getting a new card, and usually it's for the first 18 months, they charge 0% interest. So if you have $10,000 on a card that you're struggling to pay off, and the interest that's accumulating every month is hundreds of dollars, you can open that new promotional balance and then make a plan to pay off the 10 grand evenly over 18 months without having to keep accruing that $200 or $300 a month interest charge. So yes, that's a great option. Or to your point, like if you've got a 20% credit card rate, let's say you can't get that 0% interest card, you may be able to refinance it to a personal loan that is like sub 10%. So that would likely put you in a better situation. But one thing to be mindful of here is the fees. Sometimes they give you a lower interest rate, but they bury it in another fee. So be sure to look at all aspects when you're kind of mapping out what might save you money in the long run.
Next one I see is what vessels do you recommend for sinking funds? Property taxes, insurance, yearly payouts, preferably with an interest growth and minimal fees, if not any.
Yep. So this would be along the lines of the high yield savings accounts I was recommending earlier. So you can just use that. Ally and I believe Wealthfront too offer the option to have like buckets in that one savings account. So you could send, $500 to Ally every month and say 200 goes to the insurance fund, 100 goes to my travel fund. Or if you're the bank you use, like let's say, I don't think Capital One offers the buckets, but they do have a great savings account. So you could just mentally earmark it, or you could have two Capital One savings accounts and say, here's my insurance one, here's my travel one. But definitely the high yield savings account is going to be the best for that.
Perfect. And that's all the questions I have in my chat box. Do you know if any personally came through to you?
Yes, I have one more here.
Okay.
I think from the beginning of is a home an asset or a liability? I've heard it both ways. So, oh wait, I guess I did answer. But to re-answer the question, the home is going to be an asset. Now, obviously, there are things that come with home, like the maintenance and things. There are going to be expenses that you need to be cautious of. But from a balance sheet perspective, the value of your home would be considered an asset. And the mortgage on the home is your liability there. Okay. I think that was all of them too. But like I said, you guys have my contact info, so feel free to email me with any follow-up questions. I'd love to hear from you guys. And Peyton, this was awesome. Thank you for including me and putting this on.
Absolutely. Thank you so much. I mean, like I said, I'm getting a lot of feedback that this was very helpful. So thank you so
Awesome.
much. We appreciate your time. Um, Duncan folks, just know that this was the first of our four. So next week there will be a little bit more information coming on estate and longevity planning. So we'll send out more information for that. But thank you, Adriana. We appreciate your time. And hopefully, if you get any questions and people reach out, you'll be able to work with them as well.
Yeah, sounds good.
Awesome. Thank you
Have a
so
great week, guys.
much.
Thanks.